Good day, everyone. Imagine you're setting sail on the vast ocean of investing. The waters are unpredictable, the storms sudden, and the horizon often obscured. Yet, many embark on this journey with a map drawn in hope rather than reality. Today, I want to share with you 4 brutal truths about investing. Truths that are seldom discussed, but are crucial for navigating these treacherous waters. These insights aren't meant to discourage but to prepare you, to equip you with the understanding needed to make informed decisions and avoid common pitfalls. Most people enter the world of investing with a deeply emotional perspective: hope, excitement, fear, ambition. They think success in markets is about being right, feeling confident, or trusting a hunch. But the reality is far less forgiving. The market is a reflection of economic mechanics, human behavior en masse, and probabilities. It doesn't reward your optimism or punish your anxiety. It simply is. Your feelings are irrelevant to its movements. One of the hardest things to accept is that you can be absolutely certain about something, emotionally invested in it, and still be wrong. You might pour hours into research, develop a thesis that feels bulletproof, and still lose money. Why? Because markets are complex systems influenced by countless variables, most of which are beyond your control. Supply and demand, interest rates, credit cycles, geopolitical tensions, central bank policy, mass psychology. These are the forces that move the needle, not your intuition, not your conviction, not your story. Let's say you believe a company is undervalued and bound to rise. You might even be right eventually, but if you're wrong about the timing, or if the broader market enters a downturn, your position could get crushed. You could end up selling at a loss simply because the pressure became too much. That's what happens when emotion enters the equation. You start reacting instead of thinking. You stop seeing clearly. You confuse market noise with signals. You stop being objective. In my experience, the greatest investors aren't necessarily the smartest or the most passionate. They're the most rational. They're the ones who can step back, strip away their ego, and look at things through a clear, unsentimental lens. They don't fall in love with their positions. They know they're going to be wrong sometimes, and they build systems to handle that. They respect the market's indifference. They don't try to impose their will on it. They adapt to it. This detachment is critical because investing is, at its core, a probabilistic exercise. You're not trying to be right all the time. You're trying to make decisions where the expected value is in your favor over time. That requires humility. It requires accepting that you're not smarter than the market, and that your feelings about where things should go don't matter. What matters is the data, the patterns, the underlying mechanics. The market doesn't care if this is your retirement fund. It doesn't care if you stayed up all night analyzing a stock. It doesn't care if your identity is wrapped up in being a good investor. It doesn't care if you feel like it owes you a win after a string of losses. It just does what it does, and your job is to understand it, not to argue with it. Once you can make peace with that, once you truly internalize that the market is not your enemy, but also not your friend, you can begin to approach investing with the clarity and discipline it demands. And in that shift, you start to separate yourself from the average investor who lets emotions drive decisions. Most people misunderstand diversification. They think it means owning a bunch of different stocks, maybe from different sectors or industries, and assume that's enough to protect them. It's not. Real diversification is far deeper and more structural. It's about understanding how assets behave relative to one another under different conditions, especially during times of stress. If everything in your portfolio moves the same way when the environment changes, you're not diversified, you're exposed. The fundamental truth is that we live in a world of uncertainty. No one knows for sure what the future holds, whether inflation will rise or fall, whether growth will accelerate or contract, whether central banks will tighten or ease. You don't know, I don't know, nobody does. The only rational way to prepare for that uncertainty is to own a mix of assets that can perform well in different scenarios. That's the essence of good diversification, not betting on what will happen, but positioning yourself for whatever might happen. People often make the mistake of chasing returns by concentrating on what's recently worked. It feels right in the short term, but when you concentrate your risk, even if you think it's in safe assets, you become vulnerable to unexpected shocks. Markets don't move in straight lines, and assets that have historically done well together can break down simultaneously in a crisis. You see it again and again. People holding diversified portfolios of only equities, maybe with some tech and some financials, thinking they're safe. Then a market downturn hits and everything falls at once. What you want instead is balance, true balance. That means owning assets that have low or negative correlations to each other. Assets that respond differently to changes in inflation, growth, interest rates, and liquidity. When growth is strong and inflation is low, equities tend to do well. But when inflation rises sharply or growth contracts, bonds or commodities may serve as a better hedge. That's why diversification across asset classes, stocks, bonds, real assets, cash, even alternative strategies, is essential. It's not about maximizing your returns in every single environment. It's about minimizing the chances that a single risk wipes you out. The goal is resilience, being able to weather different types of economic storms without having to predict them perfectly. That's where most investors fail. They think they can anticipate what's coming and position accordingly. But the truth is, you don't have to know. You just have to be prepared for multiple outcomes. The irony is that when you build a well-diversified portfolio, one that looks boring to most people, it actually performs better over time. Not necessarily because it wins big in the short term, but because it avoids the major losses that destroy compounding. That's the power of thoughtful diversification. It gives you the ability to stay in the game when others are forced out. So the next time you hear someone dismiss diversification as just a buzzword, understand that they're not managing risk. They're gambling. And over time, the market punishes gamblers, but it tends to reward those who respect uncertainty and build around it with balance and discipline. Trying to time the market is one of the most common and costly mistakes investors make. It's rooted in the illusion of control, the belief that with enough information or intuition, you can consistently buy at the bottom and sell at the top. But the truth is, even the most experienced professionals, with all the tools and data at their disposal, rarely get it right. Markets are driven by a complex set of variables, many of which are unknowable in advance. Prices move not just on fundamentals, but on expectations, psychology, liquidity, policy decisions, often all at once. The timing game is rigged by its very nature. Most people think they're making rational decisions, but what they're really doing is reacting to noise. They chase performance when prices are going up and panic, sell when markets fall. This behavior is deeply emotional and almost always destructive. You can see it in the data. Investors tend to underperform their own investments simply because of bad timing. They buy high, seduced by momentum, and sell low, driven by fear. And they repeat that cycle over and over again. The irony is that the more confident someone is in their ability to time the market, the more dangerous they become to themselves. Confidence without clarity leads to overtrading, overleveraging, and ignoring risk. It feels empowering in the moment, but over time it erodes capital. A few wrong calls can wipe out years of careful gains. That's the asymmetry of risk when you're trying to play the market's game instead of understanding its structure. Instead of trying to predict, the better approach is preparation. Position yourself in a way that doesn't require you to be right about timing. Think in terms of probabilities, not certainties. Focus on building a portfolio that is balanced across different environments, assets that can perform under various conditions. This removes the pressure of having to guess what's coming next. It's not about being right once in a while. It's about being positioned well all the time. Investing isn't about catching every high or avoiding every low. It's about compounding returns over time while managing risk. If you stay in the game long enough and avoid major drawdowns, you win. But staying in the game requires humility. It means acknowledging what you don't know and refusing to bet your future on short-term moves you can't predict. History is filled with examples of people who were sure the market was going to crash or soar and acted accordingly. Some got lucky, most didn't, and over time, luck runs out. What endures is a disciplined, principle-based approach that doesn't depend on luck or timing, but on structure, balance, and resilience. Trying to time the market is like trying to navigate a storm by predicting every gust of wind. It might feel smart for a moment, but it's unstable and dangerous. A better strategy is to build a vessel strong enough to withstand whatever comes, because in the long run, that's what actually gets you where you want to go. Most people operate in markets without truly understanding how the economy works. They respond to headlines, follow trends, and make decisions based on surface-level information. But the reality is that the economy moves in cycles, predictable patterns of expansion and contraction driven by forces like credit, interest rates, inflation, and productivity. These cycles govern the environment in which all investments exist. If you don't understand them, you're essentially investing blind. At the heart of it all is credit. Credit drives spending, and spending drives the economy. When credit is cheap and easy to get, people borrow more, spend more, and stimulate growth. But that growth isn't free, it's borrowed from the future. Eventually, debts need to be paid, rates rise, and spending slows. What follows is a period of contraction. This expansion and deleveraging process creates a repeating pattern, short-term cycles within long-term cycles. If you recognize where we are in the cycle, you can better understand what's likely to come next. For example, in a late-stage expansion, you might see low unemployment, rising inflation, and central banks starting to tighten policy. Asset prices are often high because optimism is priced in. This is a time to be cautious, not euphoric. On the other hand, during a recession or deleveraging phase, when pessimism dominates and prices fall, you may find opportunities, provided you have the liquidity and the perspective to take advantage of them. Understanding these shifts helps you see beyond the noise. It allows you to put events in context. A rate hike isn't just a headline. It's a signal of tightening conditions that could ripple through equity valuations, credit spreads, and consumer demand. Similarly, a stimulus package isn't just political. It's a lever that can extend an expansion or soften a downturn. The mistake most people make is treating each phase of the cycle as permanent. They assume what's happening now will keep happening. In a bull market, they expect prices to keep rising. In a downturn, they panic and assume the worst is yet to come. But cycles move, that's their nature. The key is to not get caught reacting emotionally at the extremes. Instead, observe where the economy is in its cycle and adjust your expectations and positions accordingly. A good investor doesn't just look at individual assets in isolation. They look at the bigger picture, the macro environment, the policy backdrop, the position in the cycle. That perspective allows for better judgment. It gives you the ability to anticipate, not react, to prepare, not predict. You don't need to know the exact timing of the next shift. You just need to recognize when the risk/reward dynamics are changing and why. Over the long run, the economy will keep cycling. That's inevitable. What matters is how well you understand those cycles and how effectively you position yourself to navigate them. If you can stay objective, stay aware, and stay grounded in how the system actually works, you're already ahead of most investors. Investing isn't about chasing the next big thing or reacting to market noise. It's about understanding the fundamental truths, preparing for various scenarios, and making informed decisions. Remember, the goal isn't to beat the market, but to achieve your financial objectives with as little risk as necessary. By embracing these truths, you position yourself not just as an investor, but as a prudent steward of your financial future. Thank you for your time, and I wish you wisdom and clarity on your investing journey.